Ever feel like everyone around you is talking about stocks, crypto, and real estate, but you're still stuck at square one? Does the world of investing seem like some exclusive club? A fortress only accessible to the experts? Well, what if I told you that building your first investment portfolio isn't just for the wealthy, and it's much simpler than you might think? Today, we're going to demystify it all, step by step. Welcome to Wealthnetic, where we believe financial knowledge is a journey we take together. Our goal today is to give you the confidence and the clear, actionable steps to start investing and plant your very first financial seed. So, why should you even bother with investing? Let's start with a silent thief that's eating away at your savings right now. Inflation. If your money is just sitting in a regular savings account, its buying power is actually decreasing over time. That $100 today won't buy you as much in 10 years. Investing is your best defense against this. It's how you make your money work for you. Now, let's talk about the magic of compounding. Albert Einstein supposedly called it the eighth wonder of the world. And for good reason. Imagine a small snowball at the top of a hill. As it rolls down, it picks up more snow, getting bigger and bigger, faster and faster. That's compounding. Your initial investment generates earnings, and then those earnings start generating their own earnings. Over time, this effect can turn a small, consistent investment into a substantial amount of wealth. It's the single most powerful force in building long-term financial security. Ultimately, this all ties into the bigger picture. Achieving financial freedom, whether that means retiring comfortably, buying a house, or simply having the choice to work because you want to, not because you have to. Investing is the vehicle that gets you there. It's not about getting rich quick. It's about systematically building wealth over your lifetime to reach your goals. All right. Before we dive into the how, let's clear the air and bust a few common myths that hold people back. This is crucial for building a solid foundation. First up, the biggest myth of all. You need a lot of money to start investing. This is completely false. Thanks to modern technology and financial innovation, you can start with as little as $5 or $10. Many brokerage firms now offer fractional shares, meaning you can buy a small piece of an expensive stock like Amazon or Google. The key isn't how much you start with, but that you start. Small, consistent contributions are incredibly powerful over the long run. Myth number 2. Investing is the same as gambling. People who say this are usually thinking of high-risk day trading or betting on volatile meme stocks. That's not what we're talking about. True investing is about calculated risk and long-term strategy. It's about owning a piece of a real, productive business that grows over time. While gambling is a zero-sum game with odds stacked against you, investing in a diversified portfolio has historically produced positive returns over the long term. It's a calculated strategy, not a roll of the dice. Now that we've debunked those myths, let's talk about the essential foundations you need in place before you invest a single dollar. Think of this as building the launch pad for your rocket. Foundation number 1, and this is non-negotiable. Have an emergency fund. This is 3 to 6 months worth of essential living expenses saved in a high-yield savings account. Somewhere safe and easily accessible. Why? Because life happens. If your car breaks down or you have an unexpected medical bill, you don't want to be forced to sell your investments at a bad time to cover the cost. Your emergency fund is your safety net. Foundation 2. Understand your risk tolerance. This is about how comfortable you are with the ups and downs of the market. Are you the type of person who would panic and sell everything if your portfolio dropped 20%? Or can you stomach the volatility for the potential of higher long-term rewards? Your age, financial situation, and personality all play a role. Be honest with yourself. There are plenty of online quizzes that can help you figure this out. And foundation number 3. Define your financial goals. Why are you investing? Is it for retirement in 30 years? A down payment on a house in 5 years? A new car in 2? Your timeline dramatically affects your investment strategy. Longer-term goals, like retirement, allow you to take on more risk for higher growth potential. Shorter-term goals require a more conservative approach to protect your principal. Write your goals down and be specific. This gives your investing a purpose. Okay, foundation is set. Now for the exciting part, actually building your first portfolio. We'll break this down into 5 simple, actionable steps. Step 1 is to choose your investment vehicle. This is simply the account where you'll buy and hold your investments. For beginners, there are 2 main paths. The first is a traditional brokerage account with firms like Vanguard, Fidelity, or Charles Schwab. These give you full control to pick and choose your own investments. The pros are low fees and a huge selection. The con is that it can be a bit overwhelming if you're just starting. The second path is a robo-advisor, like Betterment or Wealthfront. You answer a few questions about your goals and risk tolerance, and their algorithm automatically builds and manages a diversified portfolio for you. The pro is that it's incredibly simple and hands-off. The con is that they charge a small management fee, usually around 0.25% per year. For a true beginner who wants to get started without the stress, a robo-advisor is a fantastic option. Step 2 is all about diversification. You've heard the saying, don't put all your eggs in one basket. That's the core principle here. If you invest all your money in a single company's stock, and that company performs poorly, you could lose everything. Diversification spreads your money across many different investments to reduce your risk. The easiest way for a beginner to diversify is through index funds or ETFs, which are exchange-traded funds. An S&P 500 index fund, for example, lets you own a tiny piece of the 500 largest companies in the US with a single purchase. You're instantly diversified across different industries. This is why legendary investor Warren Buffett recommends low-cost S&P 500 index funds for the vast majority of people. For beginners, it's generally wise to avoid picking individual stocks. It requires a lot of research and carries much higher risk. Stick with broad market index funds and ETFs to start. Step 3 is asset allocation. This sounds complicated, but it's just about deciding the mix of different types of assets in your portfolio, mainly stocks and bonds. Stocks represent ownership in a company and have higher growth potential, but also higher risk. Bonds are essentially loans you make to a government or a corporation, and they are generally safer, but offer lower returns. Your mix depends on your risk tolerance and time horizon. A simple rule of thumb for a young investor with a long time until retirement might be an 80-20th split. That's 80% in stocks and 20% in bonds. For someone more moderate or closer to their goal, a 60-40th split might be more appropriate. A robo-advisor does this for you automatically, but if you're using a brokerage, you can easily build this mix yourself using a stock index fund and a bond index fund. Step 4 is the secret sauce. Automate and contribute consistently. This is where the real wealth building happens. Set up automatic transfers from your bank account to your investment account every week, every 2 weeks, or every month, whatever works for you. This strategy is called dollar cost averaging. When you invest a fixed amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. This smooths out your returns over time and takes the emotion out of investing. You avoid the temptation to try and time the market, which is nearly impossible to do successfully. Just set it, forget it, and let your money work for you in the background. Finally, step 5. Review and rebalance. About once a year, take a look at your portfolio. Over time, because of market movements, your original asset allocation might drift. So, let's quickly recap the path to building your first portfolio. First, understand why you're investing. To beat inflation and build wealth through compounding. Second, build your foundation. Create an emergency fund. Know your risk tolerance and define your goals. Third, take action. Choose a brokerage or robo-advisor. Diversify with index funds. Set your asset allocation. And, most importantly, automate your contributions. The journey of 1,000 miles begins with a single step. The most important thing you can do right now is start. It doesn't matter if it's with $500 or just $5. Start small, stay consistent, and commit to learning along the way. Your future self will thank you for it. Thank you so much for joining us on this journey today. If you found this guide helpful, please hit that like button. Subscribe to Wealthnetic for more simple financial guides, and let us know in the comments what you want to learn about next. See you in the next video.